Welcome to the weekly video update, where I'll go over the action in the market for February 6th through the 10th, and then we'll see how things look for February 13th through the 17th. Just to go back and look over the week session, on Monday, market participants were pretty hesitant because Fed Chair Powell was giving a speech, and they thought maybe in this speech he's going to give some kind of information that's going to spook the markets. Also, you probably heard about the Chinese spy balloon that was shot down, and that was in all of the news cycles for a while, and everybody was talking about it. We didn't really know if that was going to escalate beyond what it has, at least yet. Then on Tuesday, the market was pretty much flat as the Fed chair gave his speech. He didn't really say anything that was all that surprising. The goal is to get inflation down to 2%, and this can take a while for that to happen. The markets ended up whipsawing. If they liked what he said, it shot up. If they didn't like what he said, it went back down. Then on Wednesdays, we had a pretty significant decline. In our daily analysis, it's showing that the markets are pretty overextended right now and looking at least short-term exhausted. We're starting to bump into upper resistance and coming back down, so the market started to pull back. There wasn't really any reaction to the State of the Union address because we have a divided Congress split between Republican and Democrat right now. They're not all that concerned about what will happen, but the market still pays attention, especially right now as we're going through this debt limit situation that hasn't been resolved yet, and are there going to be any increased regulations? On Thursday, we had a gap higher open, only to spend the rest of the day declining. Then on Friday, there was a real lack of conviction. We went a little bit up, a little bit down, and nothing really got solved in that session. Oil prices are starting to go back up. This gave some pressure to stocks because on Friday, Russia came out and said that they're going to cut production by 500,000 barrels coming in early spring, and this is due to international sanctions. So oil right now is just a little bit below 80 at 79.66. So for the week, energy was the only sector to really have a gain. Interest rates and the dollar were both up, and that also provided some headwinds for stocks. And the stock market continues to be overbought. We're working that off right now. It did give back some gains, but overall really lacked conviction. One technical note, the S&P did close below 4,100. That's more of a psychological level, but as we're playing things out and dealing with support and resistance, 4,100 has become more of a technical level. Looking back for the week, the Dow was down 1.11%. Volume was slightly above average. One thing that's a little bit positive right now is as the market's been chopping sideways and going a bit lower, we are seeing volume start to taper off. So when we see declines on a decrease in volume, that can be taken as positive. The technicals were still looking fairly positive overall, but we're starting to see some weakness come in. On the daily charts, we're kind of in between right now. We have a positive backdrop, but we're seeing more short-term weakness. Inflation and interest rates continue to be the real fixation of the market because that's feeding over into growth concerns both inside the U.S. and internationally. We want to keep an eye on all the geopolitical events. We're in the middle of earnings season right now, and those will be released. With a continuation of that coming in the upcoming week, there's all this debate going back and forth about recession debate. We did get a little bit of Fed speak this past week that really didn't have much of an influence. We're getting some more in the upcoming week. Our trend is still weakening overall. We're below 20 on the weekly chart. The green line is still on top, so we are positive. On the daily chart, we're positive as well. We're above 20, but we're starting to roll over a bit. And even in the weekly chart, we're rolling over, and I'll show you that chart. Here's the intraday action. Going back to Monday, it was pretty flat overall. Not an awful lot happened. We went up a little bit, kind of chopped all around before closing. Then on Tuesday, the markets were a little bit lower in anticipation of Chair Powell's speech. Started to go up a little bit, and then when he said something positive, the market darted up, only to fall back down. And then we saw some strength going into the close, and that set the high for the week. Then on Wednesday, we gapped lower and kind of drifted lower throughout the session. On Thursday, we gapped higher, and it looked like things were turning a lot more positive, but then we spent the rest of the day just going down. Then on Friday, we just chopped above and below the unchanged level. For the week, the Dow was down 0.2%, the NASDAQ was down 2.4%, the S&P, as I said, was down 1.11%, and the small caps were down 3.4%. We've been seeing small caps really perform well, and now they're starting to pull back a bit as the market has become overextended. For the week, this shows how the NYSE was the only index to be positive. It was up 0.1%. All the other indexes ended up being down, with small caps being down the most. Going back to the beginning of the year, all of the indexes continued to be positive, with the NASDAQ 100 and the NASDAQ in the lead. The Dow, way over on the right-hand side, it had held up better last fall going in through the end of the year, but now it seems to be lagging behind the market. Going back to the all-time high shows how the mid-caps and the Dow have held up the best, but every one of these indexes is negative. Over on the right-hand side, the NASDAQ 100 and the NASDAQ, they've paired a lot of their losses, but they're still quite negative overall. Looking at the sectors, the one sector that did really well this past week was energy. As the market was going up at the beginning of the year, energy was getting hit. Now this past week, with things being overextended and really lacking conviction, a lot of folks were getting back into energy. Communication, which has been doing well so far in 2023, really took a hit this past week, followed by discretionary. These are two areas that saw a lot of weakness in 2022 and saw a good start to 2023, but they gave back some of those gains. Looking at the sectors, energy was the only sector that was really up over the last 5 trading days. If you go from Friday to Friday, energy was the only one up. If you just take the 5 trading days this past week, we also had healthcare and tech were slightly positive, with all of the other sectors being negative. This is going back to the beginning of the year, showing how discretionary, communication, and tech have really done quite well. Real estate, which got hit a lot in the latter part of 2022, is also rebounding. Then over on the right-hand side, the areas that were hot in 2022 have now started to underperform, with staples, healthcare, and utilities. Going back to the all-time high, energy is still in the lead. All of the other sectors continue to be negative. Looking at sentiment, sentiment had become extremely greedy, and we're starting to back up off of that. But now we're back in the positive area, so we're not giving an extreme reading currently. And here's the historical chart to show you how we came up above 75 and now we're starting to back down. Looking at the VIX, it still spent a lot of the week below 20, but then with Friday's action, it climbed back up above 20. It's still very low. When the VIX is low, it's time to go. And that's producing some fear in the market that's not being reflected in the VIX because this is a fear gauge. Looking at the bottom, we see how the VIX did tick up this past week. The active asset manager survey coming out is starting to look a little extreme positive. They gave a reading of 85.4. Now this is a week old, and they're getting pretty optimistic about things. And when we get to a reading of 80 or above, we use that as a contrary indicator. Doesn't mean we turn around right away, but we start looking for the market to be overextended to the upside. This chart takes the fear and greed index that I just showed you. Here's the historical chart, and then matches it down below with the S&P 500. And when we topped out with our sentiment, a lot of times that marked some kind of a top in the S&P. Well, we're seeing a pretty extreme reading now, and the market has been coming back down. This is a chart put out by Real Investment Advice that you can go consult. You can also subscribe to it and receive it by email. Looking at the S&P 500, they're suggesting that we might be seeing a head and shoulders bottom, where over here is the left shoulder, the head, where we hit the low in October, and then a right shoulder that we hit right near the end of the year. That usually is a bullish signal, suggesting that the market could go up. We also have this trend line that we battled with a lot in 2022, and we were able to break through it in 2023. If we keep coming back down, there are different areas of support. They drew this dotted line here as one potential area of support. If we fall back down, we have the 50 period moving average, the 200 period moving average, and other fib levels that I also talk about in the daily videos. We'll just be watching this. If we really slice down through these levels, that means that things are a lot more negative than we thought. If this support area holds, any one of these areas, if we fall down to it and then bounce back up, that could be pretty positive and really give some good support to stocks. The latest reading of the RightX Bear Bull ratio shows that folks are kind of in between right now. They're not extremely bearish, and they're certainly not extremely bullish right now. The latest reading of the AAII survey shows that we were able to cross back above the 0 line and we're in more positive territory. This is another chart that is a bit of a lag because it's a week old by the time we get this information. We really pay attention to this chart when we're extreme negative or extreme positive. We're not showing that right now, so we don't really pay all that close attention to this other than the fact that we're above 0 and advancing. So according to this chart, individual investors tend to be more bullish on the market. On Friday, we had the latest release of the consumer sentiment. That is the blue line here, where it is improving slightly, but it's still 66.4 is not a very positive reading. And then we compare that to the 2-year yield. These have a tendency to move in the same direction and not get all that far apart, even though they're on different scales. What we're seeing here is the 2-year Treasury yield and the spread between that and consumer sentiment is still very wide. And it's been that way for quite a while through a lot of 2022 and now going into 2023. Over a period of time, something will probably give. Either people will start to feel better, that will push the blue line up, or interest rates will have to come down, or a combination of the two. Our Ulcer Index on the weekly chart, we're still showing a lot of complacency both on the daily chart and here on the weekly chart. We're below the moving average, suggesting that folks are pretty complacent right now, and that can be a dangerous spot. Looking at the economy, we're still holding up fairly well. The spread between risky loans and not as risky loans still continues to drop. If we were really headed into trouble economically, we would see this really spike up. Well, currently we are going down. And then the Chicago National Financial Conditions Index, when we get above this black line, that means there's economic problems. We're below the black line and declining, so they're not necessarily seeing any fear at this time. One chart that I go to quite a bit is called GDP Now, and it's a forecasting tool for GDP. Well, the Federal Reserve Bank of Cleveland also has a thing called Inflation Now casting, and this is just measuring what is inflation looking like. The red line here is CPI. That's what they predict it will be. The blue line is the core CPI inflation. The yellow line here is PCE inflation, and then the green line is core PCE inflation. The reason I bring this up, on Tuesday this coming week, we have CPI. The market is really gearing up for that. If it comes in hotter than expected, that could really produce some downward movement. If it comes in as expected or even lower than expected, that could really support prices going higher. So we just want to keep an eye on inflation because that's the fixation of the market. Looking at the current Fed watch, we have a 90.8% chance that at their next meeting on March 22nd, the Fed will raise interest rates to 4 3/4 to 5%. That would be 25 basis points higher than where we're at right now. There's a small camp thinking that we might raise rates 50 basis points. If the CPI comes in a lot hotter than expected, you would expect this number over on the right to really go up, this 90.8% chance to really decline. But we don't know if that's going to happen yet. The Fed balance sheet continues to decrease their assets. This is also producing some headwinds for stocks because a lot of the support that came in after the whole COVID crisis really helped the market to go higher. Well, now that it's coming down, there's less liquidity in the market. Looking at breadth, we're still hanging in there. Based on price and volume, we're above the moving average with both price and volume. So even though it ticked down just slightly, we are still positive overall. The advanced decline ratio going back 19 or 39 periods shows that we did increase this past week and we're above 0. So that's positive. New highs, new lows, didn't see a lot of action there. Not a real breakout in new highs or new lows. So we're continuing to go up with the 4-week moving average, even though it rolled over just slightly. And we're pretty much flat to slightly declining with our 10-period moving average. Accumulation distribution is showing that we're still above a rising moving average, but it did decline this past week, but it is still positive overall. Our trend is just showing how the ADX has come down below 20. It is turning back up, but it's still below this moving average. The green line is still on top, so we default to positive. Our Arun shows a decrease in sellers as well as a decrease in buyers, so it's pretty much flat overall looking at our oscillator. The mass index is not generating a signal right now. Some longer term charts. First we look at the daily chart, how we came right up to this R1 level and we've been coming back down. The December highs had been providing support. Well, we have since broke through that. Now we have other support going back to a low set in 2021, and we're just above that. We came down through it in Friday's session, but closed back above this black line. Here's some of the other support levels that I showed in that Real Investment Advice newsletter. If we continue to fall, we might see some support at this pivot level, which is at about 39.88. The trend line continues to go down. It's right now at about 39.69. And then we have the moving average, the 50 period, and the 200, which also may provide some support if we continue to fall. If we go sideways, not much will really change. If the market ends up going up, we have some pretty good resistance at the 41.82 level, and there's other support and resistance that I'll show you as we go through the Fibonacci charts. We're still at the upper side of the midpoint of our trend channel going back to the 2009 low. Here's some other pivot points showing that we're still positive overall. We're above the monthly pivot, even though we did decline this past week. We're still above the 50 period simple moving average. And on a weekly chart, that equates to a 200-day moving average. That's positive. We haven't seen a golden cross yet with our long-term trend, but it is showing some improvement as long as we can stay above both of these moving averages. The bullish percent index, after giving us a pretty extreme positive reading, has since been declining. And we're seeing very similar action right now on the daily chart. It went up above 70 and is also declining. The Chaikin oscillator, looking at the long term, is not giving us an extreme reading. It's still positive overall, but it did decline. The Chaikin money flow is holding up fairly well. It actually advanced this past week and is positive. The force index declined a little bit, but it's still above zero, so it's positive. The McClellan oscillator is more negative. It's dropped below zero and is declining. The summation index based on price is still above zero, so that's positive but declining, and based on volume. And we're seeing this pretty much the same on the daily chart, where based on volume we came right up to an extreme reading and now we're starting to come back down. So to see this on the daily chart and the weekly chart tends to confirm each other, and that just suggests that we're overextended to the upside. Looking at our oscillators, we're still positive with the slope and the TSI. The MACD continues to go up. The PMO, the PPO, and the TRIX continue to be positive, as does the KST. We're seeing a little mixed picture now on the daily charts, where most of our short and intermediate term charts are rolling over, and a few have actually crossed negative, where they're still looking positive on the weekly chart. The Swellen trading oscillator, based on price and volume, continues to decline, so that's negative. And sometimes this indicator can be a leading indicator, where it starts to measure things before they actually happen. But then there are times when that's not the case, so we want to use other tools and not just put all of our faith in this. Here's our PMO study showing how the PMO continues to go up. Based on price, it's above zero but declining, and based on volume, above zero and declining. So it's still positive but showing some weakness. Another PMO study shows how the PMOs that are rising continues to fall, the buy signals is declining, and the PMOs that are above zero also declines. And we're seeing very similar things in the daily chart. The RSI based on 14 periods, we're positive overall because we're above 50, but we did decline this past week. The special K continues to be positive even though it's getting closer and closer down to this moving average. The Stochh RSI is still giving us an extreme positive reading. Williams percent R did give us an extreme positive reading, but is now starting to come back down. The vortex is still positive with the green line on top and advancing, and the red line's on bottom, and it was pretty much flat. Ultimate oscillator, positive because it's above 50. It did come up, but is now starting to move back down. Money flow index, this is more negative. It's still below 50 and declining. And Bollinger Band's not giving us any kind of an extreme reading. It's above this dash line, which is positive, but it did show some weakness. Rate of change going back 1 week, we had a down week, so the rate of change did decline. Going back 50 weeks, it did decline this past week, but is showing some improvement overall. The Copic curve, we finally got rid of the Copic curve on the daily charts, which gave us a signal in early January. This one looks like it's just about getting ready to roll over, and it may do that in the next week or two. So that would make the Copic curve buy signal go away. Doesn't mean we don't pay attention to it anymore and we don't use that buy signal. It just means that the signal that was generated has gone. Looking at the weekly chart, we're still holding up pretty well here, even with the decline. We're above both of the moving averages and we're above longer-term fib support. Our different charts, seeing kind of a mixed picture. The Heiken Ashi continues to be positive with open candles. The Kegi is positive. The Renko still has an open box. The ease of movement, going back 1 week, did decline a little bit, but is still above this dashed line. Going back 14 weeks, we're still looking positive. Nothing new on the point and figure chart. We have a weekly signal called an ascending triple top breakout that was generated at the end of January. So this is still looking positive. The 3-line break is still looking positive. And on our daily charts, we're seeing kind of a mix. There's a few of these charts that are starting to show more negative candle and bar action. Looking at our trading system, we're back to neutral with the Elder Impulse system on the weekly chart. Parabolic SAR. This is what gave me a warning sign earlier in the week. We were going up on the daily chart. We had some recent weakness, and then boom, the parabolic SAR put a dot up on top, which is negative. I really focused on that and started to look for other clues, and that suggested that things are turning more negative. We're still positive overall, though, with the weekly chart. Some broad market measures, looking at the S&P, the mid caps, and the small caps. Not seeing an awful lot of divergence just by eyeing this chart. All stocks continue to be positive and just gave us a recent golden cross, even though we saw some weakness this past week. The mid caps also working off of a recent golden cross, both on the daily and the weekly charts. So this is still holding up, even though we were down on the week 2.5%. Small caps also just giving us a recent golden cross, even though they were down on the week. The Dow, recent golden cross, and is still holding up longer term. The NASDAQ still has not given us a golden cross. It needs to get above both of these moving averages and stay above them for a while for this to generate a golden cross. And the same thing is true with the NASDAQ. Looking at the Wilshire, a broad-based measure, haven't crossed over with the golden cross yet, but as long as we can stay above both of these moving averages, that is likely to happen. The NYSE did give us a recent golden cross in early January and is looking much better. The FANG stocks, not near a golden cross, were down on the week, but still showing some improvement, as with ARK. It bottomed out at just under 30, had a really nice run up, probably enough to get some folks back into this ETF, only to see it down over 8.5% over the past week. The biggest software companies showing some improvement, but still has not produced a golden cross. Looking at Dow theory, not really seeing much. We saw a bit of a breakout here with the transports against the Dow, which is not necessarily confirmed yet. The Dow's been really lagging and going sideways, where it had really shown some strength since last fall. So we're seeing a bit of a divergence here. The transports are breaking out a bit, but we're not really seeing that with the Dow, where the utilities continue to show some weakness. Some broad market measures. Here's the CRB index. We just saw a recent death cross and we're in an overall downtrend, even though they ticked up this past week. I have some more on commodities that I'll talk about later. Copper is still in an overall uptrend, but it's beginning to chop around a bit on the daily chart as well as the weekly chart. We want to keep an eye on this because if copper's going up, that usually suggests that the economy looking forward looks better. If it's going down, that means the economy could be weaker looking forward. Gold, after giving us a recent golden cross, has pretty much spent the last couple of weeks declining, and the same with silver. Recent golden cross, but now declining. Oil, after dropping down the low to mid-70s, has since bounced back, and we're just below 80. The dollar, after having been in a real solid downtrend, is seeing a bit of a bounce, and that could be giving some headwinds to stocks. When the dollar was really going down, that's when we saw a lot of strength at the beginning of 2023 anyway, going into the stock market. If we see the dollar going back up, that could produce some more headwinds for stocks. Looking at bonds and interest rates, we're not quite at a golden cross yet with the bond ETF. We're looking better on the daily chart and improving a bit on the weekly chart, even though we declined this past week, but we haven't crossed over yet. Here's a daily chart of yields, how they had been coming down, but over the last few days of last week, we saw interest rates really going up. Here's the MOVE index showing the volatility in bonds after it had been coming down is now starting to go back up. When the VIX is low, it's time to go. When the VIX is high, it's time to buy. I don't have the ability to really do much more than this chart right now. I don't get any data for this particular index, so we can't do an awful lot of studies. Here's a weekly chart showing the US, UK, and German rates are starting to go back up, and then Japan is kind of its own little story. Their rates are still pretty low. Looking at our intermarket analysis chart, we're still going up with oil when you go all the way back to the end of 2021, followed by the dollar, and gold is still somewhat positive. Stocks and bonds continue to be negative. Even though stocks have shown some improvement, bonds are not really reflected yet in this chart as improving. The bond to stock ratio, not really seeing anything here that's really telling. The stock to bond ratio just shows that stocks continue to outperform bonds, even though they had a more difficult week last week. Looking at gold to the US dollar, after really coming back up, gold was starting to outperform, but is now turning back down as we're seeing some recent strength in the dollar. Gold to the S&P 500, kind of the same thing. With gold declining, the S&P actually is outperforming, even though this ratio continues to show gold is outperforming the S&P. Looking at some low volatility stocks, they're still in an overall uptrend, but we saw some recent weakness, but this past week they did tick back up. The growth to value ratio also in an overall downtrend, but showing a little improvement. NASDAQ 100 to the S&P 500 still shows that the NASDAQ 100 is underperforming the S&P, and the S&P 100 continues to underperform the S&P 500. Discretionary continues to underperform staples. Energy continues to outperform tech. And then looking at some longer term charts, this is based on Martin Pring, and every week he has a blog post and he has some interesting charts to show. A lot of these charts I have, but I wanted to include his annotations on the chart. This first chart is the bond commodity ratio, and then at the bottom is his KST, which is an oscillator that he developed. What we're looking for over on the right-hand side is another relative buy signal for bonds. The reason why we're looking at bonds is this could give some support to stocks. If bonds are going up, that means interest rates are coming down, and interest rates going lower could help the stock market. And this shows where the KST is starting to go back up, showing that bonds could perform well if this overall trend continues. The chart up above is the 30-year bond. It's still in an overall downtrend, but it's starting to show some improvement. Here's another one showing the bond commodity ratio, where bonds had really been underperforming commodities. Then down below you have a short-term KST, which is still overall negative but going sideways, and then an intermediate term KST, which is showing just a little bit of outperformance right now. We're going to be watching for some kind of a breakout to the upside or a breakdown to the downside to help us determine if bonds are really getting more attractive, which could help interest rates to go lower. Here's the CRB composite, which measures commodities. They had really been rising up, and now they're starting to roll over. And a lot of times when we see a rollover with the KST, commodity bond ratio, this will often suggest that the CRB index will continue to fall. This is not the S&P that we see up above. This is the CRB index. If the CRB index continues to fall, that could give some support to stocks, since the CRB rising is generally considered inflationary. Here's the S&P 500. With the commodity bond KST on the bottom, showing how commodities are starting to roll over in relation to bonds. This could give some support to stocks, and you can see other times it didn't necessarily mark a bottom, but it did help to show a continuation of an uptrend. Then this is just looking back. These pink areas are bear market. This is called a secular bear market. Again, everybody's going to have a different definition. Secular means long term. Then you have cyclical bull markets, which happen inside of secular markets, and it can get all crazy, and everybody has a little bit different interpretation. Here's the S&P on the top, showing how things have been performing. Here's the stock to commodity ratio. And generally when we're in a bear market, we'll just see little peaks above this moving average. When we get out of the bear market and then we're able to get above this moving average, that is usually much more positive for the S&P. Looking over on the right-hand side, a decisive cross below the moving average is a sign of a secular bear market. So according to this, we're in a bear market right now. But if we can turn back up and get more positive and get back above this red line, that would turn things more positive. If we do get back above this red line and we're still in a bear market overall, then we wouldn't expect this to go very high above the red line. So what's our outlook then for the upcoming week? The major economic reports coming out. There's nothing on Monday. On Tuesday is going to be the big one. That's CPI, and there's a lot of anticipation ahead of that report coming out. Then on Wednesday, we have the mortgage applications index, retail sales, that's another biggie, industrial production and capacity utilization, business inventories, the NAHB housing market index. On Thursday is another big one with PPI coming out, as well as housing starts and building permits. We get our weekly jobless claims. Then on Friday, we have import and export prices, and then the leading economic index or indicator will be coming out. We're keeping an eye on the technicals. They're still holding up better in the weekly charts. We're seeing more weakness in the daily charts right now, but if we see follow-through downside, it's going to start to damage our weekly charts. If we see some real upside movement in this upcoming week, that could really help the technical picture. The markets, of course, are now more than ever really fixated on inflation and interest rates with the CPI coming out this week. And then we're still dealing with this whole debt ceiling situation. What will likely happen is it'll come down to an 11th hour decision and it'll be the headline news and everyone's going to freak out about it. The market may even react negatively to this. And then finally they'll reach some kind of a deal. Everybody will be relieved. And then the market may show a relief rally in response to that. But that hasn't happened yet. Looking at the statistics for Monday, we do have a pretty positive day on Monday. The Dow's up 57.1% of the time. That's more neutral to positive. But the S&P and the NASDAQ are up 71.4% of the time. And then these other areas, I'm just going to go through them quickly. I don't want to make this video too long. We're still working off a 3-0 trifecta. And the markets really like that we're split between Republican and Democrat. Here's the Stock Traders Almanac chart, just showing how we're getting into the sweet spot of the 4-year cycle. This green line is how things have performed in the past, and then the black line is the S&P right now. It's a little bit outdated. This chart is now a few weeks old. If we're going to hold to historical norms, this should give some support to the market. And then this is the S&P 500 pre-election year in aggregate scale. This purple line, this is where we're at. Again, this chart is a little bit old, but this could also give some support to stocks going forward. We do have a couple of speeches that will be given in the upcoming week, none by Chairperson Powell. We'll have a speech by Governor Michelle Baumann on Tuesday at 8 a.m., and then on Thursday, Governor Lisa Cook will be giving a speech. The markets will be watching this, but they're not as fixated on this as they are when Chairperson Powell speaks. Then another thing that I got from the latest newsletter put out by Real Investment Advice, which you can go to, it's freely available. These are some of the warning signs that we're looking at right now. The first one is that earnings and forward estimates are declining. And I've been talking about that a lot in the videos, and that will ultimately have an impact on stock prices because they're driven by earnings. If a company's not earning anything, its stock price will go down, and the inverse of that is also true. Inflation, even though it's declining, is still pretty high. It's well above 5%, and this has preceded every recession in history. The Fed is still hiking interest rates, even though they've slowed down a little bit. That's another headwind. The market continues to ignore liquidity contraction as the balance sheet of the Fed continues to contract. Economic growth is slowing. The consumer, which comprises about 70% of GDP, is struggling just to make ends meet. With inflation falling, corporate profit margins will contract. And unemployment at very lows has always preceded a recession and valuation contraction. So this is not positive by any means at all, but this just gives us some bullet points that I've been talking about in the daily and weekly videos, is adding more to the negative backdrop, even though we're seeing more of a positive backdrop when we look at our charts right now. Then here at the bottom is a link if you want to go and look at this newsletter. Our scenarios based on how things look for Monday's session. We can't really go with the down scenario yet. The technicals are still positive overall, but they're turning more negative. And we can't really go with the up scenario because the technicals are positive, but we're seeing more negative action. We're not seeing any follow-through price to the upside, at least yet. Our possible positive scenarios, they're taking a bit of a hit this past week as sector rotation and our positive setups. I didn't show any of those charts because when we have a down week overall, there's really no improvement on those. Our technicals are still positive. We have a lot of moving averages, pivot levels, and fib retracements that may provide resistance if we go up or support if we go down. Can't really go with the neutral trend right now because the ADX is above 20 and it's getting stronger and it is positive. So if anything, we would default to the up scenario, but we have to see follow-through price action, and especially if we can get above resistance. Thank you. I hope you found this useful. I'm also preparing the intermarket analysis video update as well as the deep dive video and the supplemental video that I will post over the weekend.